How to Build Incentive-Based Compensation Plans. Brought to you by CFO On Demand from Fitzpatrick, Bongiovanni, and Kelly CPAs. Please support our sponsors: McPeak Wealth Management Group of Wells Fargo, Ansero IT, Levin Staller, Attorneys at Law, Allegra Marketing, Integris Investing, Tim Pashley, Cooper Levinson, Attorneys at Law, Rich Asset Management, Ocean First Bank, Sturdy Savings Bank, Bank of America, Persky Marone, Attorneys at Law, Merrill Lynch, Altor Oakley Group.
Hello, I'm Timothy Pashley, Financial Advisor with Integris Investing. The relationship a client has with their existing or potential advisor must be built on a foundation of trust. The Know Your Advisor checklist is intended to serve as a guideline for investors to help ensure that their best interest is foremost in every decision and to foster a relationship of trust and integrity. I encourage investors to delve deeper than a firm's sales brochure and ask questions that will enable you to better understand an advisor's motives and qualifications. The goals and objectives related to your assets are specific to you. Make sure your advisory relationship is one that reflects this priority.
And now our presenter, Lou Bongiovanni.
Hello and welcome. This is Lou Bongiovanni from CFO On Demand, and thanks for joining me this month. A few things I want to cover before we get started, some housekeeping things. Since this is a live webinar, one of the benefits is you can ask questions. So feel free to submit questions during the webinar. I'll leave a short amount of time at the end if you want to ask some questions as well. I'll be the only one who sees the questions, and I'll be able to answer them at the end. Also, number two is after the webinar, all people who have registered will receive a link so that if you wish to listen to the webinar again or want to share it with somebody, you'll be able to do so. Okay, let's get started. Based on the number of attendees, I can see this is a hot topic. One thing that I've experienced in consulting the last few years is a recurring issue with clients who are looking to grow, and that issue is finding and keeping qualified help. That is something, it doesn't matter what industry it is or what level we're talking, there is clearly a qualified labor shortage in this area. Much of it was spurred by the casinos a few years ago when there were major layoffs. A lot of families and employees moved out of the area. Now trying to attract them back is a challenge. So clearly I see this issue quite a bit, and I thought it was worthy a webinar, and we're going to touch on some points here. So here are our objectives. We're going to discuss how to determine employee return on investment. We'll explore the financial aspects of hiring somebody and how to determine what your return on that investment is. We'll also discuss how to motivate employees to act like owners. And last, we'll touch on the 7 ways or 7 factors to develop incentive-based compensation plans, which we've found are very effective in keeping key employees. Let's start by throwing some statistics at you with return on investment. Over 70% of employees are disengaged in the workplace per Gallup polls at any given time, and that is across the board. That's a national survey. A disengaged employee brings down production up to 35% of the company, so one employee can affect the entire company, and that's per the Wall Street Journal. Obviously, the size of the company is a factor in these things. But both of those examples show where one bad apple can affect the whole bunch. So it really is important that you have employees who are engaged and properly compensated. This also addresses things such as absenteeism, customer loss, a waste of a supervisor's time, or less revenue. And the last item is incentivize employees outproduce others by 200%. And there's another report, and that's from a Glassdoor report. So an incentivized employee can actually work up to 2 times that of an employee who's not properly incentivized. When we talk about return on investment, there's a few factors that need to be taken into consideration before we talk about an actual calculation or how to measure it. These factors are goals, and that is from the company level to the department level to the individual employees level. The more clear the goal is for each of those levels, the better it is to determine a return on an investment. It's important that all people involved, especially the key people, understand what's expected of the company, their department, and especially them individually. Next, company culture. You need to take into consideration the culture of your company. If your company is strictly sales driven and top line, then a return on investment will be looked at slightly different than if your company is run by someone who is more artistic in nature and looking more for profitability or the quality of the product or service. So your company culture can't be ignored when you're looking at a return on investment. So even though you have 2 companies in the same industry, you would not necessarily look at return on investment in the same way. And the last item, because we're mostly dealing with small companies, let's say 50 employees or less, is really the sweet spot in this area from what I found and the type of clients that I work with. The employee's role in the company is critical. Many times with the labor shortage, you have employees doing multiple things and multiple tasks, so they don't necessarily fit neatly into one category. They might straddle multiple categories. So you want to take into consideration how vital this particular employee is in the company. Let's discuss some measurement tools. In doing some further research for this webinar, one thing I discovered to my surprise is there is an abundance of information out there by industry, by department, by title. There is a wealth of information there. And I think one of the challenges is to find the metric that works best for your particular company, because clearly what I discovered is one size does not fit all. What I have here in this slide is breaking down all those different metrics into 4 broad categories. One is work quality metrics. The other one is work quantity metrics, work efficiency metrics, and an organization level performance metrics. Now, I'm going to go over each one of these in more depth in a minute, but one thing that you want to keep in mind that even within one organization, you might use different metrics for different people depending on what their position is and what their responsibilities are and what you're looking to achieve. Also, with these metrics, you might have industry averages and things of that nature. I would suggest that you use that strictly as a guide. I'm a bigger proponent of measuring your performance against yourself, measuring the company against itself for prior years. So for example, if you had an exceptionally good year, you might use that as a baseline as opposed to industry averages, and then comparing yourself to that baseline. But let's explore each of these metrics a little more in-depthly. The work quality metrics is one that is more subjective. Things such as customer surveys or suggestion boxes come into play here. Things such as the dreaded performance appraisals, and some people dread that, some companies do very well with it. But those type of metrics or indicative of the quality of the work the person is doing. Management by objectives is also a very popular metrics when you're discussing quality. And what you do there is you assign certain items or certain characteristics that you would like in a person in a particular level, and then you assign a point system to it. So then as you're reviewing the employee, you're trying to quantify as best you can something that is subjective. And that point system then translates into either a raise or a bonus. There's many examples of these on the internet for sure. Next is the work quantity metrics. These ones are the most commonly used and the easiest to apply. Things such as the number of sales or the sales dollar amount or number of units produced if you're in the production side of things. Again, with things such as this, you want to look at industry averages strictly as a guide, but mostly comparing it to yourselves. So things of this nature you might have, let's say if you have a lawn care service and you have a crew going out, you might measure a crew's production by how many lawns they can cut, or if you have a chef, you might measure that chef's production by how many meals they are able to produce in an evening. So there's different measurable items that you can use here for each, but again, be cautious as to what the information provides you. The next one is work efficiency metrics. This somewhat ties in the two that I mentioned before. It takes some aspects of the quality and some aspects of the quantity metrics and tries to marry the two together. And many of these metrics you can use for an employee and apply differently for each employee, and you can use multiple metrics, and maybe that'll tell a more accurate picture here. So with this metric, you're looking at the work performed, let's say, within certain time limits, or work completed within certain budgets or parameters. So if you have an electrician who sends out crews and looking to see how quickly they service a particular client, or a waitress with how many tables she can turn over, things of that nature are used here, which kind of marry the quality and the quantity metrics. And last broad category of metrics is an organizational level metric. So this is not necessarily to the individual, but it's the individual in relation to the whole company. So things such as revenue by employee. A lot of times you'll see profit by employee. And incidentally, revenue by employee for Apple, I saw, was $1 million. So they have $1 million of revenue they generate for every employee. I thought that was amazing. And that was the highest item there. But as you can imagine, many of the tech companies have some astronomical numbers there. Also, one that I think might be more applicable to smaller companies is human capital ROI, where you take the EBITDA number and divide it by the cost of the employee. So that is their compensation as well as their benefits. And that creates a ratio which you can use as a guide from year to year and see how that moves compared to the profitability of the company. So you can see how the cost of employees are impacting the profitability of the company. Now, the owner's involvement during the years that you're measuring might have an impact. For example, if an owner is actively involved and then they turn around and hire maybe another employee, or give more responsibility to an existing employee, that may affect those numbers in a way that's explainable because the employee is somewhat pulling back or maybe even completely taking themselves out of the workforce. So when you're dealing with smaller companies, things such as that nature can have a pretty dramatic impact. Let's talk about how to motivate employees to act like owners. I guess the first thing before we get into the bullet points is you want to be the type of owner that an employee wants to emulate or wants to act like. So that's one thing that sometimes is very difficult in advising clients as an outsourced CFO or as a business consultant. Sometimes the owners have to look at themselves and say, what kind of image am I portraying to my employees, and especially my key employees? Am I running around with a poor quality of life? Is my marriage in disarray, or the kids not really getting the attention? Am I always seeming to be out of control? These are messages that are somewhat subtle, but if you're giving these messages to the key employees and you want them to think like you or act like you in the business setting, it sometimes is very hard to separate you overall as the owner and how you handle things business-wise as well as personal, because I don't know about you, but I know in my life the business and the personal are so intertwined that it's hard to separate one from the other. So one thing that I think an owner needs to do is just kind of take a self-assessment as far as what message are they delivering nonverbal to these key employees. But first bullet point is communicate company goals constantly, consistently also is important, because if you want the employees to act like the owner, they need to know the owner's thought process better. And the more the owner interacts with the employees, the better. Because that way, the employees can get a feel for what is important in the owner's eyes, because many times the owners are very busy and they don't take the time to formally document it. Next item is place the employee in charge of departments or tasks with clear performance goals. If you want the key employee to think like an owner, give them ownership, maybe informal ownership of departments or tasks or projects. Let them have a sense for all aspects of it. Now, that doesn't mean you hand it to them and you go away and abandon them. This means that you're giving them ownership, you're showing them that you have trust in them, and you're staying close by so that you can oversee what's going on there. So giving a little taste of a department is a great way to have them start thinking as owners. And the third bullet point is a review company culture. I kind of alluded to that somewhat, but are there double standards? Many companies have family members who work there, or have long-term employees who are kind of like family members. If there's a sense of a double standard or an unfair practices going on, that could sabotage trying to motivate a key employee. So again, be honest with it. Some things you can avoid, some things you can't, but it's best to just discuss that up front. Some other points with that is develop profit sharing components based on company performance. Again, if you're going to have a key owner, a key employee in charge of a particular department, it's a great idea to try to incentivize them based on the performance of that department. Now, that doesn't have to be 100% of their compensation, but it can be a small portion, usually 10 to 20% of their compensation can be based on the performance of that project, depending on how involved they are. Next bullet point, and that's really the crux of this webinar, is incentivize-based compensation based on factors employees can control or influence. So one example we just discussed is having them in charge of a particular department or project. But if that is not practical or applicable in your particular company, then look at the tasks that they do and how much that influences the profitability of the company, whether it influences sales or costs, and try to develop a compensation package that works with that. Now, that is where we tend to work rather closely with clients and do some back testing. So we'll go back a few years and say, okay, if this incentive was in place, how would that have looked? And that gives the owner some comfort as to developing that. The last item here, some people believe, is to treat top performers very well and fire the rest. Now, that is somewhat of an extreme Machiavellian approach, but I have seen that used very successfully with companies. And if that logic applies well to your company, that's something that you should keep in mind. We're going to now focus on incentive-based compensation and the importance of it. And when we're talking about incentive-based compensation, we're not necessarily just talking about the Christmas bonus, which many times that's done year in and year out, and that's almost seen as an entitlement. And I'm not talking about the 401k matching contribution that you do, which again, after a number of years feels like an entitlement. I'm really focused more on incentive-based compensation that is a part of the compensation structure and can go up or down depending on very specific components of the business. The term that you see a lot, and when I was doing my research, I came across quite a bit, is truly paying for the performance of that individual. So if, again, that individual is wearing multiple hats, it's hard to compare him or her to other people in their industry because those other people may or may not be wearing those individual hats. And again, I like this quote so much, I accidentally put it on another page. So, treat the top performers very well and fire the rest. Okay, so now let's get into the 7 ways to develop incentive-based compensation packages. We know it's hard to find an employee. We know finding a good one is very hard, and we want to keep them. It's very much an employee market right now, and in order to keep the good ones, you have to compensate them more than you would normally. That is an adjustment. Many owners are still adjusting to that fact, but that is the reality right now. And sometimes, the pendulum moves, but right now, you do need to pay a premium for good employees. And what I found is they are worth it. So, number 1, develop company goals. We kind of alluded to this, where you have a company's, you want the financial outcome of the company clear to the owner. So what we do quite a bit of is company financial budgets. So when an owner is thinking about incentivizing a key employee, they're much more at ease doing that when they know what's in it for them. The budget tells them what's in it for them. So if the company performs in such a way, they're going to make this amount of money. So then when we look at a key employee and say, hey, what do you think about doing this or that for them, they're much more at ease knowing what they're getting and understanding what's in it for the employee. Also, having department or location financial budgets. So not only company-wide, again, if you're going to make a key employee in charge of a particular location or department, you want to have budgets for that as well. Company non-financial goals, where many times we're so fixated on the numbers, and I believe budgets are a way of communicating an owner's expectations. But there might be some non-financial goals, such as the owner wanting to work less, or maybe certain key employees, let's say for personal reasons, want to work less in a period of time, or more, frankly, if they have college costs, they might want to work more, but if they're near retirement, their time off might be worthwhile. Those things should come into play as well. And you want to make sure that the company goals are consistent with your long-term and short-term goals. So for example, if your short-term goal is to grow the company and sell it in 2 years because you want to retire and move out of the area, let's make sure that everything is aligned as such. If the long-term goal is you want to grow this company slow and steady, so you're going to pass it to the next generation, then we want to make sure that these company goals are aligned with that, so we fully understand what is in it for the owner. That's basically what this is. What's in it for the owner? Number 2, develop employee goals. So as much as we're focusing and have focused on step 1 with company-wide and ultimately what goes to the owner or owners, now we need to turn and look at what are the financial goals for the particular employee. So if we're looking to incentivize the employee to work at a certain rate and be a superstar for the company, then we want to make sure that there's a compensation model that pays them as a superstar. For example, all athletes aren't the same. So LeBron James might be making a salary much higher than other forwards in the league, but he's a superstar, so he deserves to make that kind of salary. So you have to be mindful of what you're asking of the employees, and if they have the capacity to be a superstar, you need to build in a financial model where they can be paid as a superstar, and that's okay. Develop non-financial goals for key employees. We kind of alluded to that, where we talked about it for the owner. Same with the employee. If you don't want to burn them out, if they want an extra vacation or things of that nature, build that into the compensation process, as long as it doesn't sabotage the business or adversely impact it. Let's see what we can give them as best we can. Clearly communicate the goals with their input. This is where you want to get buy-in from the employees as far as the goals. You don't want to just hand it to it and say, this is what expected of you, good luck with it. You want them to have input and buy-in from it so that they can take ownership and feel like they're a partner. Again, I'm using that term selectively in this process. And last, outline the rewards to them if goals are met. This is the thing that I find is owners tend to get squirmy with this, as opposed to crystal clear. If you hit this, this is what you get. And a lot of time owners will put caveats with that. And I find that becomes confusing, that breeds distrust. If the employee hits certain benchmarks that you've clearly defined, the employee wins. Now, if there's other factors that the employee can't control that may impact what goes in the owner's pocket, that's not the employee's issue. That's the employer's issue. And a lot of times the employer will tend to bring that into play unnecessarily, and I would suggest don't be tempted to do that. Number three, company culture check. I've kind of alluded to that already, but it's definitely worthy a step in the process. You want to define the company culture honestly. Many businesses are small, closely owned businesses and very informal. So when we're trying to put into place some sort of incentive compensation program for a non-owner, that works best in a more formal setting. So right there might be a conflict with the informal business and a formal incentive package. So you want to honestly assess how formal or how to put an incentive package together that works best for your business. You want to address compensation that is not performance-based. So for example, if the owners have family members or long-term employees that maybe are compensated more or get other perks that they would not normally get if it weren't for being in a small business, you need to be honest with it and upfront with it, especially if you're trying to attract or keep a key employee. They need to understand that money's not being taken out of their pocket potentially because you're giving it to a family member or an underperformer because of the history of the company here. That breeds an unfair environment, and that's the last line item that I'll talk about. That breeds an unfair environment that makes it difficult to have an incentive-based compensation. As much as you can control that, and I know it's impractical to eliminate it completely, but the more you can control and contain that, the better. I'm asked about family members constantly in businesses, and many times that is the source of a lot of difficult situations. The more you're upfront with it and you address and have timelines, the better. Item number 4 is basically do your homework. There is, as I mentioned, an abundance of information online as far as compensation for particular employees at different levels, and benchmarks. Salary.com is a popular website to go to, and many of these are little to no cost to obtain some specific information that you're looking for. The item that I think is real important while doing that is update the job description. I call it role creep, where maybe your company had 6 employees doing the work and with a certain amount of revenue. Now the revenue might stay the same or go up, but now you only have 4 employees. And basically, through efficiencies and automation, and maybe the employees doing more responsibilities, you're able to accomplish that. You want to acknowledge that when you're looking at a particular employee's compensation where they might not fit neatly because you're dealing with small companies and many of your key employees have to wear multiple hats, you want to acknowledge the fact that they might work 80% in this role and 20% in another role, but you're only paying them for the one role and really not the other. This is a good time to look at that and adjust accordingly for that. So that's why job descriptions are important, or job responsibilities. How critical is the employee to the operations? Is this employee your MVP or your go-to person? Is this employee allow you to go on vacations or cut out of the office to see your kids' ball game with complete confidence that things are being handled well in the company? If that's the case, that has a value to it. How much to attribute to it is really unique to the owner, but you can't ignore that or take that for granted. What I find happens in those situations is that if that employee is not compensated for that fairly in their eyes, that is many times a breeding ground for employee theft, where they think that, you know what, I'm not being compensated, I have all this responsibility, I'm kind of entitled to it. They kind of justify it in their mind, and a lot of times you'll see that happening. That is a topic for our December webinar, where we'll touch on that, but it's worth mentioning here where there's a sense of entitlement and that comes into play. And then lastly, determine the hours worked and when. If you have an employee on salary, who is working a certain number of hours and there might be a busier time than others, you might want to discuss with that employee the flexibility of their work schedule, where you're asking more of them during their busier time of the year, but maybe giving them some latitudes on other times of the year, so that you can accommodate them as best you can. Number 5, employee buy-in. You want to give the employees the options as to the incentives they can receive. It's not always just money, and just like the owners, the employees go through different stages of their lives where maybe at a certain time of their lives they need more time because they have younger kids. They need some more flexibility of schedules, and then as the kids settle in their schooling, they might want to make more money because they have more time to do that. And then as the kids get out of the house, they might want to have more time. So there's different things that different employees want during their stage of employment. So if you acknowledge that and be flexible enough in your compensation package, employees really appreciate that. So the employer just needs to get to know that employee a little bit more than just the annual review process. Titles too. Sometimes when you're dealing with an employee, a title means quite a bit, whether it's being a partner of a firm, or the store manager, or the department head, or whatever the case may be. Many times titles don't cost anything, but it makes the employee feel important to the organization, and the employee feels that it gives the impression to the outside world as far as that the company thinks that much of them, where they're giving them a title or a promotion. So be mindful of titles. They're worth more than the owner sometimes imagines they are. And if used properly, they can be something that's valuable for the employer to offer to the employee as well. And then lastly, family and work time balance. We talked about that in the different stages that the employees go through. A flexible schedule might be one and such. And again, as long as the overall goals of the company are met and it's understood that the company needs to have a certain level of service or performance, then you can be as flexible as you can. Item 6, compensation components breakdown. The best compensation packages I've seen have different layers to them. It's not just the base salary. It's usually a base salary for their role. Then there's a benefits package, and that may vary depending if that particular employee needs benefits or not. And then what I've seen is either one or two layers. Two layers would be an individual performance-based incentive. So for that person's performance, they are incentivized, and we talked about different metrics to use and how to incentivize them. And that usually runs about 10 to 15% of the total compensation package. And then company performance-based incentives. So this is, if the individual does well, they get a certain kicker, but then if the company overall does well, they get another layer, and sometimes that might be up to 5% of the employee's compensation package, or they'll call it a bonus pool or things of that nature. This way you can have key and non-key employees celebrate or share in the profits of the company, so they feel that they're all going towards a common goal. So I've seen incentive-based compensation packages layered in such a way. And again, the way that you compensate a person in charge of sales would have a different individual performance layer as opposed to the store manager, who's not only focused on managing sales, but in controlling costs and profitability and customer service. So there's a lot of qualifiable things there as well. So that individual performance can be very unique, but the company share can be similar. Maybe the percentage might vary, but it'd be similar. And last, use an outside professional. And this isn't, just kind of promoting our services, but I lean on a lot of HR people in this particular area. This is not an area that I tend to venture in by myself, for sure. It could be messy, and many times it is messy. A shout out to Rich Homan from Innovative Leadership of the Delaware Valley. Rich and I have worked together for over 15 years, and he is truly a pro in this area and a great resource in this area. He understands the small business market, and people such as he are really valuable. It's great to have them consult on a regular basis, as well as just being there when a crisis or an issue comes up, and you can lean on him. So people such as Rich Homan, I would highly recommend to at least have available, depending on what your particular issues are, and you can have them advise. And what's nice about using an outside professional is you have an unbiased perspective. It's hard to just one day say, okay, we're going to institute this incentive-based compensation just out of the blue. A lot of times professionals will help paint the picture for you, so you see what the outcome will look like for you and the employee. And a lot of times I'll be called in to deliver the financial parts of it, just so that it's crystal clear. And again, it's not coming from the owner. It seems like it's something special, and not just the latest attempt from the owner to try to give a different compensation package. And the things also that help by using an outside professional is addressing the family dynamics. Again, that could be at the ownership level or the key employee level. That many times comes into play and is diffused by using an outside professional, as well as office politics. So it doesn't have to be family members. It's, when you're instituting change, and that's a lot of what I do here, it gets messy at times. It can get disruptive, and many times you'll lose an employee or two in the process, but overall the company is better off for it. Those things tend to be a result of doing these type of packages. Right, and then as a quick recap, 7 ways to develop incentive-based compensation packages. You want to develop a company goals. You want to develop employee goals. Many times that's done on the annual review process for the employee. Company goals are usually at the end of the year. You want to address the company culture honestly. Compensation homework. You want to do your homework as far as what's fair compensation. Again, realizing it's an employee market out there right now. You want to get the employees buy-in in the process. You don't want to just shove something down their throat, whether it's good or bad, frankly. And number 6, compensation components breakdown. You want to tier a compensation package so that it has different layers, so to incentivize the employee during good times and bad. And then lastly, use an outside professional. This is a lot to undertake for a business owner who doesn't do this on a regular basis, and you only really have one shot to do this right. If you screw it up, it really could cause more harm than good. At CFO On Demand, we assist clients with items such as employee compensation packages. It's part of the services that we do, where we offer financial analysis and helping the internal accounting department of a client, providing them with the financial analysis they need in order to make sound business decisions. This is the image that we usually see, or the situation we usually see with small businesses, where the internal accounting department is doing their best to get the numbers and the financials together, but struggle with the financial analytics. They just either don't have the time or the expertise to do that. At CFO On Demand, what we do is we reinforce that so that the business owner could focus on growing the success of the company and not be pulled back on analytics, and feel comfortable that there is a strong support between the data that's accumulated as well as the analytics behind it. We really are trying to focus to help business owners to be more strategists, not just operators of the company, because we believe that business strategists win Super Bowls better than business operators. Of course, my assistant Rishi, who's a big Eagles fan, insisted on this one. So you see the Philly special outdoing, and I believe he missed that pass there for the Super Bowl. I'm going to, we have a couple of questions here. If you have any additional questions, you're welcome to bring that in. We have just a few more minutes here, and if you give me a second, I'll look at the other questions while I do that. Here are upcoming webinars that I invite you to attend. The next one coming up is on June 13th. That's talking about KPI, which are the numbers behind the numbers. Many times people use it that way. That is a very popular one, and one that we do all the time with clients. Okay, so let me look here. There's 2 questions. How and when should I introduce an incentive-based compensation plan with my company? We've never done it formally. When's the best time? Kind of alluded to that near the end, where many times employees are reviewed formally annually. I'm a promoter of doing it a certain time of the year as opposed to the employee's annual hiring date. At that time is a good time to discuss not only the employee's performance, but ways of compensating them in a new, more incentivized way. Other question here. We have some family members in the workplace. How do you handle the compensation arrangements for them, as well as putting an incentive package together? One thing that I think is very critical, and why I think budgets are so important, is they show how maybe overcompensating, whether it's an inactive owner or family members, how that sucks profit from the company and really takes away from rewarding the performance of key employees in the company. I think it's very important to look at that, especially during the budget process, which happens in November, December, maybe spills a little into January, and have it in front of you. And then maybe have an arrangement where if everyone agrees this is a great key employee, but in order to do that, we need to tighten our belts, that's a great way, that's a great start, at least, to it. Okay. That is about all the time we have. Thank you so much for joining us. I hope you found this informative. I know this is a topic that is not going away, and this is something that business owners are constantly working towards. So any way that we can help, we'll be glad to, and hopefully we'll see you next month. Thank you.